Hello there. Joining me on the floor of the New York Stock Exchange today, we have Scott Diamond. Scott is co-head of municipal fixed income at Goldman Sachs. Scott, what can we expect for the municipal market for the rest of 2026?
Good morning. We can expect a lot, right? It's going to be coming at us fast and furious on multiple fronts. First, municipals are an asset class just like equities, and so macro factors are going to impact us. There's a lot going on. Things are pretty hot in the Middle East. What are the implications? Does that need to increase a certain level of risk priced in the market? What are the implications for inflation? We have a new Fed chair. What is he going to be talking about out west? And is that going to give us any clarity on which direction is his Fed policy going to lean? Of course, AI has been a topic very much in equity markets, and it's actually impacting fixed income as well and causing some credit spread widening, maybe some pressure on the back end of the curve. And then munis. Munis, we are looking at maybe a third year of record supply. There's been good demand this year, but will it continue to help us absorb all of that paper? And then from a municipal credit perspective, things are kind of reverting back to trend. Upgrades to downgrades are kind of in line, and we're muni folks, so we're a little more pessimistic. Are there clouds on the horizon? We're seeing some pressure in maybe school districts. Inflation has caught up with them a little bit. AI, what are the implications for local budgets? So a lot going on, but for active managers, this is great. This is going to be a lot of fun.
Scott, you mentioned municipal credit. So we do know there's an increased supply. Does that indicate stress?
Short answer, no. We think that this is just getting us back to a normal level of investment in infrastructure. Unfortunately, inflation has meant those projects cost about 20% more. But longer answer, I would say there are some things that we want to pay attention to. We have an election coming up in November that we're going to need to see how that plays out. We have some states that actually want to increase taxes out west. There's a proposal for a billionaire's tax. And then in Florida, there's a proposal to reduce taxes or do away with property taxes. So a lot going on. Some towns have, as I said, AI embraced data centers. Some have not, and that really has the potential to impact local budgets. So a lot going on, but we think it's more of an opportunistic environment rather than any sign of credit stress.
Okay, so it definitely sounds like you think the market will be able to absorb all of this increased supply.
It has so far year to date. We've had probably about 65 billion in inflows just into funds, that's ETFs and mutual funds, not including the interest that we've seen in separately managed accounts. So there's plenty of demand. But what we're more focused about for the balance of the year, is there anything that would cause that demand to waver a little bit, in which case that supply could very quickly become a burden on the market and be a little bit disruptive. But again, that creates opportunities.
So on the subject of opportunities, there is so much going on right now. And as you mentioned to begin with, and what could behold after midterms, do you think that the opportunities are abundant for you? And if so, where are you and your team finding them?
Oh, now we got a fun question. Yes, short answer, there's a lot out there to pick and choose from. Our starting point is where yields are at or near the highest levels they've been in years. And if that's our starting point, then we get to look across the entire municipal landscape. I would say, just using our ETFs as a proxy, we have GMNY. It's an opportunistic New York fund. We have recently added a U.S. territory bond in 3 years at a yield of 3.5%. Now, that's great on an absolute yield level, but for a New York taxpayer, that's close to 7%. That's going to be a great distribution or accretive to our shareholders. Maybe moving to the other end of the curve. The muni yield curve is very steep right now. And so for our opportunistic California ETF offering, GCAL, we added, leaning on our research team, a triple B hospital in 20 years that offered a yield of 5%. And so on a tax equivalent yield, that's going to be very powerful for our shareholders. Lastly, even just for our national fund, GMUB, utilizing our research team, we invested in a special assessment district. This is phase 5 of a residential development, and it's doing really well. And so we were able to add that in 10 years at a yield of 4.7%. So absolutely, we think that the offering out there is really attractive. Just make sure you have the right people in place to pick the right securities.
Good stuff. Is there anything else you'd like to add?
Listen, headlines have been fast and furious for the last handful of years. Even year to date, they've been fast and furious. We see no reason that that's going to change between now and the end of the year. So be ready, be nimble, and have the right team behind you to take advantage of this great yield opportunity.
Scott, thank you for your time and your insight. That was Scott Diamond, co-head of municipal fixed income at Goldman Sachs. I'm Erin Raal, and this is Asset TV.